back to JPX and market weekly updates. Crude oil prices were down slightly last Friday and failed to resume the upward momentum in place since the midweek release of latest EI report. All crude oil benchmarks were heading for small weekly losses. Middle East spot crude markets largely improved in flat price terms, playing catch-up with the previous session's Brent gains that came after Singapore close, with premiums for spot barrels consolidating at lower levels, but was still down on the week. Dubai cash for October delivery was assessed at around $92.8 per barrel for August 19th, up $2.4 per barrel from the previous session, while JPX Dubai futures were up $2.7 per barrel on the day at around $98.7 per barrel for the October contract. Dubai market structure stabilized after hitting multi-month lows, with its first line and third line spread kicking back above $4 per barrel, while the JPX Dubai future spread was patched at $3.2 per barrel on the day. Russian and Ukraine war has resulted in shifting trade patterns, leaving Europe to find substitutes for Russia's oil. This change has driven up the Brent and Dubai spread to a level high enough to reduce Russia's imports of Brent crude oil and to retain more oil in Europe. However, the spread fell in the past 2 weeks due to weaker European refinery demand and increasing supply. According to shipping data, Russia's crude oil export rose by 140,000 barrels a day on the month to average 3.36 million barrels a day, to remain above pre-war levels for the fifth month in a row as sanctions impact remains muted. Russia's export to the Netherlands, Italy, and Turkey all rose sharply in early August. The Brent and WTI spread has also increased enough to attract more imports of crude oil from the United States into Europe. The price spread increased to a high of $13 per barrel at the end of July, the highest spread since January 2014. From March to July, the Brent and WTI spread averaged $6 per barrel and almost $2.5 per barrel increase from the first 2 months of the year. The EI reported last Wednesday that U.S. crude oil stocks dropped by an unexpected 7.1 million barrels last week, while U.S. crude oil exports were estimated at a record 5 million barrels per day. It's the highest U.S. export volume ever reported. Over the next year or two, while the U.S. ratcheted up in production in response to high prices as Europe scrambled to replace Russian crude oil, Gulf Coast export terminals will be well called upon to load and ship out even more crude oil on a regular basis. It should also be noted that if the existing oil-related infrastructure, which are estimated to have a combined maximum capacity of over 60 million barrels a day along the coast, would be capable of handling a real flood of crude in the future. In the medium term, these wide price spread we noted above will keep export from Europe to Asia subdued and encourage high imports from the United States, both of which will likely be necessary as the European Union reduces crude oil imports from Russia by 90% by the end of this year. The market is also watching for further developments surrounding the Iran nuclear deal. After 18 months of negotiations, progress has been made in reviving the deal, with no official word over the past weekend, as the EU and the United States are reviewing Iran's response to the final text. According to early reports, Iran did not demand that Iranian Revolutionary Guard Corps be removed from the State Department list of foreign terrorist organizations, which had been a major sticking point in efforts to revive the Iran nuclear deal. U.S. investment bank Goldman Sachs sees an immediate deal as unlikely, as under the current setup, both sides are still be able to attain something beneficial without having to concede ground. Should a deal be reached soon, Goldman expects as much as 1 million barrels per day of crude oil to find its way onto the market in short order, up from the 2.7 million barrels per day the country still will be able to produce despite the current sanctions regime. In the natural gas market, gas prices in Europe are soaring again because of supply disruptions from Russia. TTF gas price traded as high as €250 per megawatt hour, and oil equivalent to more than $400 per barrel. European refinery margins are being squeezed as the cost of hydrogenation has risen sharply due to soaring gas prices. Asian LNG futures soared to recent high this week, with buyers increasingly forced to compete with runaway European prices. North Asian benchmark JKM futures for December this year, January, and February next year were all settled at above $60 per million British thermal heats for the first time, as key buyers including China, Japan, and South Korea prepare for winter shortages. As we noted before, the JKM prices are likely to be particularly volatile during the second half of this year. The JPX LNG contract would still be a good choice to hedge against fluctuations in spot prices. Okay, that's all for today, and welcome back next week.